you. Just this move down yesterday, just very, very manic, coming right at the 235 period. And instead of it being 235 to the upside, it was 235 to the downside, very violent, followed by some institutional covering and some covering in that last 15 minutes on Wednesday afternoon. But what happened with the Russell? Well, the Russell is the story right now, and I want to be paying very close attention to the Russell over the next couple of days because as I'm going to explain some significant moves. Have a good day. Bye, honey. My daughter's off to camp. Some very significant moves on the Russell, and it's about the pressure in the Russell that we have to be paying very close attention to. So we'll dig into this a little bit this morning, but hey, Secret Agent Charlie, good to see you. Good to see everybody. All right. As you know, exit liquidity, you have these big moves that happened yesterday after the bell on Meta, and you had it on Microsoft, and both of these names were up shockingly. Huge move for Meta, up 78 points, 11.2% this morning, and on top of that, Microsoft pushing to these levels. Big pre-market moves, but don't be stunned if you see some reversals on these names a little later this morning, because again, you are the exit liquidity in this market. If you are trying to buy in certain rallies, you got to pay very close attention to how the market is positioning in the futures market in the pre-market hours and what is being set up right now in the wake of the Fed meeting. So thanks for joining us, everybody. Looking across momentum right now, very hard to find smaller breakout stocks. This is a interesting environment because you have a lot of concentration in names that are absolutely ripping, and then you have these continuation of breaking down stocks, companies that continue to just show on and more weakness, as we have seen in the last week, particularly in the underbelly of the Russell 2000, which we'll dig into in a little bit. Now, right now, looking across the board, you have a lot of strength and momentum. You have a lot of names like Generac, and NVIDIA continues to be very, very strong. And we have Microsoft, but you want to pay very close attention to ANF. The cyclicals are under pressure at the moment, but it is this line in the sand for Abercrombie that we're paying very close attention to, up around 99 at its 200-day moving average. Very strong, smooth momentum for that stock. CoreWeave, obviously back in focus. CoreWeave has been just one of those names that if it can get back above this 20 and this 50-day moving average, there is strength to the upside, but do not test it. This can be resistance in this environment as we continue to see weakness in the underlying portion of the technology sector. And it doesn't necessarily feel like it, but it's there. And we've seen this really happening within the Russell itself as the number of stocks that are in breakdown territory, breakdown mode as we are defining it, the poor man's version of it, just looking at the number of stocks that are down 5% on the week and the number of stocks that are down on the month, just weakening momentum across the board with relatively elevated beta over 1. You have 34 of those names across the Russell 2000's technology sector. If you edit that, you flip this over and you just look at the number of stocks that are breaking out comparatively, it ain't as good, 21. So more capital on the end of the bell curve, leaving the capital on the on one side of the bell curve compared to the other. And it's a number of other stocks that are under pressure. I was watching this yesterday as the sell-off happened. Basic materials are under pressure. We saw my Powell drop. I had to pull the plug momentarily and watching this, see if it can hold at that 110 level. In addition, industrials under pressure, financials are under pressure, and this is going to be one of the bigger stories. I've been talking about the KRE. The KRE continues to bleed off right now. I know that Don is paying very close attention to the regional banking space. I don't know what is going on here, but I will say that I've been paying attention to the KRE's recent sell-off just through the lens of what is called the DPST. This is the leveraged ETF around regional banks, and we have dropped under those three key lines, and you can see weakness across the board on all these different momentum oscillators. Weakness here, and what is the problem? I don't know, But I am a little bit concerned when I see this, simply because I look at that and then I'm also watching AIG, which historically has been kind of this harbinger when there are issues in the global financial system. This is the big sell-off that transpired in April. This was the Nikkei crash that happened last August, and we've seen this pronounced move lower on AIG to levels that we have not seen since that period of time right here with the with the trade collapse. Questions really abound ahead of the meetings between the United States and China in the weeks ahead. I am just raising the caution flag at the moment as we look at this. At the end of the day, you have other names like HT Group, right, trying to hold above that 20-day. If that finds resistance there, a move down to the 50-day is what I'll be looking for on HUT. In addition, ChargePoint, one of the companies that does not deserve to be public or around anymore, continuing to weaken. They'll probably reverse split this stock another 15 times before it finally does reach the dustbin of American history. Great numbers there, fellas. Income minus 270 million on a market capitalization of 208. And you wonder why we have concerns about the markets and the stability of them over the long term. KEP back in focus as we look at the number of stocks that are on that 20-day moving average, lined up with strong F score and strong Graham score. Remember, Piotrowski score stocks that have very high quality numbers, and the Graham score signifying value. We're looking for the combination of quality on the F. Low Graham means strong value, and then the strength on that 20-day moving average is the momentum that we are seeking at all times. On top of that, CRC, watching California Resources, same story, trying to hold above this line. And energy is not as bad as it was about a week ago, but I would be very, very cautious about the energy sector right now, simply because of the weakness that we seem to be seeing in some of these names like NE, which is Noble. Pay very close attention, as always, if you are an energy trader, to the OILU. And if the OILU starts to crack under these key moving averages, look to short higher beta upstream oil and gas names. If this can rebound and find support and start to push back higher, you're going to go the other direction as well. Looking at the Russell right now as it continues to chop around this morning, we're going to dig a little bit deeper into the weakness of the Russell and why it's going to be very important to be watching the Russell in the coming days. But I do want to add STNG on top of this, Scorpio Tankers. A lot of these names have been very, very beaten up over the last year and a half. If Scorpio can get and hold above that 200-day moving average, there may be some strength here. Just watching all of this convergence of these key momentum lines coming together, that is where, if we start to see these lines can reach equilibrium sometime in the next month, maybe 3 to 6 weeks, you're going to be looking for a stronger directional move one way or the other. So it sets up for a potential straddle play, or you just simply follow the momentum in the direction and set individual stops right back at those indicators. But remember, don't set the stop right at the indicator. Keep a mental stop. That is what the algos are looking for to try to force you into a sale. And ASC is back in focus. This is a name that has popped up over and over and over and over again. Ardmore Shipping. This is a really good long-term buy, but it's going to take some time. What's interesting about Ardmore is that it is a company that has one of the youngest fleets in the world, and it focuses on specialty chemicals. So very strong dividend, very strong company, but the overall, again, broader macroeconomic situation is in play. So just keep this in mind, that it would be a much, much, much longer term play at this moment than it is to have a, try something to trade. If you're trading, you want to be focused on those high beta names, or you want to obviously be focusing on the indices themselves. Overall, S&P 500 number of stocks breaking down on the intraday have dropped to negative 16, but as we noted, there's still ample strength in the Russell 2000. You look at the MAGS, the Roundhill ETF, breaking higher again today, and the FNGD, which is our line in the sand, is down 7% today. So this is that environment that we kind of always chat about, the idea that you have this wall of worry, these broader concerns, and we see significant amounts of consolidation into the top names in the S&P 500, which can take the market higher. But at the same time, we see pronounced weakness other places in the market, which is what we're going to outline right now as we talk about the Russell. Is it appropriate to place a put spread on Meta now? Yeah, no. Wait it out. Not trading 5 days after the earnings. Smart strategy. Again, if you are focusing on reversions, that's different. If you're looking for these kind of moves that are all the way down at the fourth or fifth standard deviation, that's an opportunity to trade it. But aside from that, yeah, it's one of those things where it is important to wait and not try to chase anything. In addition to that, you're going to see a lot of that unwind on that volatility crush based on all the people who are making big bets ahead of these earnings or hedging, etc. All right, 8:56. We'll dig into the Graham numbers in a little bit if we have a little bit of time. But for right now, the conversation needs to be about the Federal Reserve. And I know it's not the most exciting thing in the world for some people to have a long conversation about monetary policy. But let me tell you something. Some of us spent way too much time studying this, and you're going to learn about it. You're going to listen to me talk about it. Hey, you want to really confuse somebody? Ask my mom about dinners of me talking about central banking in 2015. Riveting stuff. All right, how Powell's tone rattled markets and why the Russell 2000 will take the brunt of this. So overall, looking at what happened yesterday, the FOMC held its rates at 4.25 to 4.5%. That's the fifth consecutive hold. Now, there are two dissents out of this, Waller and Bowman, and we've talked about how there's a possibility that Waller would be in contention to be the next Federal Reserve chairman, but they have both called for a rate cut. Some have said that this is the most divided that the Fed has been in 30 years. I would have to confirm that number, but it's one of those headlines that I saw this morning. And if I look at this, Powell emphasized persistent inflation and data dependency. And if we look at what happened this morning, the PCE inflation gauge came in at 2.6, which was a little bit higher than the expectation of 2.5%. There has not been any confirmation whatsoever for a rate cut in September. But we did see the odds change, and it was a pretty significant shift because, once again, we were expecting 1 month ago a 75% probability based on the market, the way that the market was pricing in rate cuts, 75% chance of a 25 basis point cut in September and 20% for a 50 point cut. That has changed dramatically. We have come all the way down to 39%. And as Ed Mines is saying in the chat, we might never cut rates again. But the purpose of this, though, is not to really focus and overemphasize on what's happening with the S&P 500, but to really examine what the impact is elsewhere in the U.S. market, right? So we're 65% down to 39%. We saw a short-term spike in Treasury yields. We saw U.S. dollars, the U.S. dollar strengthen. We've been watching this transpire with the UUP. There would be a potential for a lot more ample covering on the U.S. dollar, looking for the UUP to potentially test this 200-day moving average in the day ahead. Once again, I continue to just note the UUP is a dollar bullish ETF. There's virtually no time cost when you are using options on this out a couple of weeks. So keep in mind, if you're just trading around these key moving averages, just keeping good tight stops, there is ample upside using the UUP. And on the other side, when the dollar does sell off, the UDN. If you're not one for trading dollar futures, these are just cheap tools that are out there that exist that retail traders can use, and they are heavily linked to momentum, which is nice. All you have to really do at the end of the day is just be paying very close attention to where we sit with the RSI, the MFI, and the ADX, and just looking for that momentum to be returning on all of these different oscillators with time. Once again, the UUP is the dollar bullish index, and the UDN is the bearish index. So equity markets reversed earlier gains as Powell had spoke, and we saw that big reversal at the end of the day resultantly. So one of the key things that we're paying very close attention to is the fact that the risk sentiment shifted mid press conference. And that's where you get these moves. That's where you get this type of sell-off that really just kind of comes out of nowhere and spooks a lot of people. And even though we're paying very close attention to potential moves outside of deviation lines and outside of Bollinger Bands, it can be very, very difficult to try to actively trade these for reversals simply because the news and the overreaction is so ample. So later in the day, we did see a reversal, but it came very late in the last 15 minutes, coming off the second standard deviation and the bottom port of the Bollinger Band when we had a little bit of tightness. So a rally to the upside, very short-lived. We're starting to obviously pay very close attention to what is going to happen today, but I want to keep focusing on the difference between what the Russell did and what the S&P 500 did and what the NASDAQ did. So the Russell dropped yesterday, sharpest drop among indexes, and 0.5% might not seem like much. It might not seem like much, but when we compare it to what the S&P 500 did, which was resilient, and we saw the Dow Jones have a little bit of a broader decline because of concerns around industrial stocks, the NASDAQ once again showcasing the tech resilience and the fact that there is still ample amount of capital that is rallying around these very few names in the broader market. Now, here's why the Russell 2000 is more vulnerable to downturns, especially in periods where interest rates remained elevated. This is pretty simple. 40% of Russell 2000 firms are unprofitable. They don't make money, and that's according to Apollo's chief economist. So they not just have that, but there's a couple of important things to keep in mind. They have weaker passive inflows, right? So if you look at a company like Tesla, or you look at a company like Apple, or you look at a company like Amazon, they are supported heavily, not just on the independence of the stock and the enthusiasm around them, but the sheer number of ETFs that these stocks are in, the sheer amount of leverage that these stocks are utilized for the purposes of levering up positions within the broader market. They also have ample amount of what is known as active crowding, where because fund managers are trying to replicate the performance of the S&P 500 because that is their benchmark, they will actively trade those stocks at the top of the S&P 500 and the top of the NASDAQ. There is much less liquidity down here in the Russell, and there are weaker passive flows in the Russell. Also important about the Russell 2000 is just the structure of those companies. These are largely small cap companies operating in the United States. So when we talk about the idea of fundamentals and we talk about the connections to the economy, the Russell really is a better reflection of the realities of the U.S. economy and the U.S. system. The S&P 500 has lots of distortions. It has lots of passive investment. It has a lot of different ETFs that are collectively gobbling up all of these different types of stocks. But the Russell does not have that level, right? And the Russell also has rule-based balancing that actually will add lower quality firms when they do their annualized rebalancing. So 3 very important things to keep in mind. Measures that I had pulled this morning, the Russell carries about 3 times the leverage of the S&P 500 firms, and that goes back to the indebtedness of a lot of these names. For a lot of these companies, their debt is often a floating rate. It will hit harder if rates rise and if rates will remain elevated. A lot of small firms depend on rolling short-term credit, so their refinancing risk is high with these higher and longer-term sustained yields, and you can see this through the period of time that has transpired with the S&P 500 being, or forgive me, with the Federal Reserve keeping interest rates elevated. A company like Beyond Meat, which is a perfect example of a zombie stock on the Russell 2000, has watched its value erode in these high interest rate environments, and we continue to see moves lower and moves lower and moves lower. But I will note, the one thing about all of these zombie stocks, and particularly the ones that are heavily shorted, like this one at 38% of float, when they do start to break out above their key moving averages, and you will see on a very consistent basis, very often, that the 20-day moving average is under the 50-day moving average as these things continue to bleed off. When they get back above their 20 and their 50, it is an ample opportunity for a short squeeze. And we saw this transpire recently, 2.85 down to 4.6. And now it's starting to sell off again aggressively, largely on the back of the short squeeze unwinding, but also the fact that once again this company is not profitable. It lost $160 million. Its sales are 319 million. Its market cap is 250 million. Its price per book share is negative. It is not profitable. It is a company that is eventually going to go away, or it is going to be taken private by some private equity company that doesn't know what to do with their money, or, in my view, hates their money. All right, so if we look at this, zombie stocks, which are important to really truly understand, squeeze fake meat. Ugh, company is the worst. Just get out of my kitchen. All right. Zombie stocks have much lower earnings power. So when there are rising interest rates or elevated rates, it increases their, quote, solvency risk. And they have a limited ability to raise capital in tighter financial conditions. Now, what's very important about this is that just like we make that argument very often that the market can remain solvent more irrational longer than you can remain insolvent. In a world where we're constantly printing and expanding capital in the financial system, these companies can survive a lot longer because they can find creative ways to expand their balance sheet, to increase debt. Really, that's the key thing. Do they have the capacity in any way on the liability side of their balance sheet to borrow more? And if they can find it, they will take it. If they have to dilute, they will dilute. If they have to go out and do a special tenure, they will do that. But if they can figure out ways to do this, they can keep the party going for longer. And once again, a lot of executives who do this and operate in these environments, they are compensated in stocks. So they are keeping the music going for as long as they possibly can. But these are also companies that are very vulnerable to bankruptcy or sharp equity repricing. And once again, we've seen this time and time again, particularly around earnings events or particularly around negative momentum events, where you see a drying up of capital in the system. And these stocks get pulverized in a very quick manner because, again, they are heavily shorted stocks. And when there are these liquidity events, we see a little bit more of an amplification of the efforts to short these names. It can be a little bit frustrating to try to short these names because you may be paying more because of the higher implied volatility. That's why it's always important to pay very close attention to what the IV52 or the IV30 is. We'll cover some of that in our discussions tomorrow in our member room, just kind of breaking it down, how to identify the top stocks for that. But when you see a lower implied volatility on some of these names and you see things cool off and you see these pops on names like Beyond Meat and some of the other zombie stocks that are out there, they do become rational shorts. It can just be very, very difficult to time it because sometimes these rallies around the GameStop style stocks can go on a lot longer than people anticipate. I've talked before about the Altman Z-score, and the Altman Z-score is a 5-point bankruptcy probability score that was created by Professor Altman. I believe, I can't even remember what year it was, but once again, it is a metric that will tell you about the stability of the company's banking structure. Financial structure. And if the company has an F score or a Z score over 3, it's very healthy. If it's under 1.8, it's not very healthy. It's actually very bad. You're going to see on a lot of these zombie stocks, you're going to see negative Z score stocks sometimes, suggesting that these are companies that would face extreme credit risks in the event of, say, a 2020 style sell-off, in the event of, the type of event that we saw in 2023, where interest rates went, the 10-year interest rate went to 5%, or the gilt crisis that transpired back here in September and October of 2022. Beyond Meat, I believe, split adjusted from 40 down to 15. These are the types of names that really are vulnerable when you have these major events that suck up liquidity and make it very, very difficult for some of these companies, particularly if they are using short-term debt instruments to be able to refinance their existing debt, or they have to refinance it at higher levels, which obviously impacts the financial structure of the company and can lead to these types of moves, right? Where we went from 126 split adjusted down to $50 during the COVID crisis. All right. On top of that, this is very important, and I can't stress this enough, because one of the biggest shifts in the global financial markets of the last 30 years, I've said before, there were 6 things that happened in the early 1990s that forever changed the structure of the United financial system and really undercut the stability and utilization of S&P 500 stocks as pure indicators of economic activity and fundamentals. And it really kind of goes back to 1993 when they created the very first passive ETF, which was called the SPY. And you know it well because it is extraordinarily liquid, and it is fun to trade, and it has options that expire every single day. But that didn't exist back then. And the SPY was really just created as a vehicle initially to allow people to have broad market exposure to the S&P 500 rather than trying to buy all these different stocks and actively manage it. You could just replicate the performance of the S&P 500. That was the goal. And then the manic infrastructure of passive investing took off, and the manic infrastructure of daily options and options trading took off. Now, I'm not complaining about that. I'm just stating that it distorted the markets in many different ways. And it has led to the situation where the SPY has massive passive inflows, and all of the stocks that are part of the SPY are part of massive levels of S&P, ETFs. I talked about the Catholic ETF, and I've joked a little bit about this, but it's a serious thing, right? This was an ETF that was created back in 2020-ish, maybe, and it was supposed to be focusing solely on what the values of the Catholic Church were. And it underperformed. So what did they do? They changed their name, and they went out and they bought all of the stocks on the S&P 500 and just called it the Catholic S&P 500 Values ETF. It's basically the SPY. So now you have another ETF basically just replicating the SPY, and there's not just like 10 of these, there's hundreds of these, and they all own the exact same stocks. Well, the Russell 2000 doesn't have this. You're not going to see Beyond Meat in 350 ETFs. You're going to see Beyond Meat in thematic ETFs. Oh, and by the way, if you want a little bit of a joke around this, at one point, I've said, like, what are all of the things that actually make this a Catholic ETF? I can't find one until I get down here. Home Depot, everybody, because Jesus was a carpenter. All right. During stress, money rotates out of small caps quickly, and we are starting to see that. Large cap ETFs act as liquidity havens. The Russell gets abandoned. Very important. So as we connect the dots and we look at this, Powell's tone was very hawkish, more hawkish than expected. The yield spiked. The pressure on leveraged rate-sensitive firms increased. The Russell 2000 was more exposed due to credit and earnings risk. And that's going to be the narrative for the next couple of weeks as we move toward Jackson Hole. And it's whether or not the Russell 2000 in this environment is going to be able to hold. Liquidity in the financial market is still very, very strong. Small caps suffered with large cap indexes held up. So as we look at this and we see what is happening right now with the Russell, I would just simply state there are multiple ways to go against the Russell if you want, right? You can take the RTM, the TWM, and the SRTY, and we'll make these charts available. These are simply inverse ETFs. You have 1 to 3 times leverage, and they are short-term only inverse plays that you can utilize. You have ways to short it using our IWM put options. High leverage, defined risk, best for swing trading. RTY or the MKT futures, that's more for active pro traders, but there's very high liquidity. Yeah. and leverage in this, and that's going to give you the most bang for the buck. Shorting the IWM, which requires a direct exposure via margin. Again, going back short term for them. Well, you're going to see in a second. But there's obviously risk of recall if you're just trying to flat out short the IWM, or you do a pair trade where you're long SPY or Qs and you're shorting the IWM. So you're hedging small caps versus large caps from a macro view. And the way that I kind of put this into a grid, the leverage within the RTY and the M2K is much higher. But if you're looking for something simple, the RWM is straight inverse, right? So you don't have to worry about decay in that, right? So looking at the Russell breaking above inverse Russell breaking above its 20-day moving average, potential way to just trade this is to go long here and sell up here. This is a little bit more illiquid, so that's why IWM puts are unique and easier to trade. But on top of that, looking at the TWM, which is a little bit more leverage, it is a double inverse ETF around the Russell. So this is something that if you're going to trade it, your stop needs to be right back at the EMA 20, and you don't want to hold this more than a couple of days. But I will just note that there are options around these things. There are kind of lottery picks, and if we get above that 20 and that 50, and there is something wrong in the broader market, these do become those short-term trades that you want to take a shot at, hopefully cost you 25 to 50 bucks. And if they hit, they hit. And if they don't, you move on and you just take the cash that you from other, again, capital intensive assets that we've laid out. TZA is the triple bear ETF as well. Thank you, Matt, pointing that out as well. SRTY is on here as well. People kind of overlook the SRTY. This is the Ultra Pro Short 3 ETF, very, very similar to the TZA. Liquidity not good on the TWM. I think you will see a lot more liquidity on the triple leveraged ETF more than anything else, largely because that's really been utilized as a hedge. We're starting to sell off a little bit. We'll see how we hold up, but it is 917. I am currently short the Russell, by the way, heading into the next couple of days. I'm shorting it from here to here, right? So I'm at 220 down to 215, and that was one of the stories that we were talking about yesterday in our masterclass. Finally, keep a very close eye on all of those names, those high short interest names, and just get used to knowing who they are, right? Companies like Kohl's, companies like Ayers, companies like Wolf, RTZ. This is highshortinterest.com. A lot of these names are those zombie stocks that we are talking about. And a lot of these names, if the Russell starts to break down, they will see more stress as well. You just have to be very, very careful and make sure that you kind of draw your line in the sand. Be aware that if you have a stock like Hims, which is, still supposed to be a good company, but obviously the financials are not lining up at the moment, given the current status of affairs. If this rolls over on the Russell, don't be shocked to see this stock move back lower. Same thing goes, though, with virtually anything on this list. Groupon's still a public company, I guess. When was the last time you used a Groupon? Be honest. All right, Groupon to 31.54, and everything momentum-wise looking pretty ugly. That's an interesting little opportunity here, trying to go take aim at it. If you're going to try to short a name like Groupon, particularly if the Russell weakens, just be aware. Once you get down into these oversold territories on MFI and RSI, it creates an environment where they are ripe for short-term rebounds. So Hims is not liked in our chat today. That's okay. Everything on this table should be in focus. And once again, pay very close attention to those 20 and those 50-day moving averages, Soundhound, other names like that. So that's it. All right. It is 9:20. That means Don Kaufman is going to be coming up with some music relatively soon. I'm going to be back here with Blake at 1 o'clock for an hour. Looking forward to that. And then I will be back for my next masterclass later today at 2:30 on Tesla, continuing to look for weakness. And it would be nice to see this market cooperate and give us our real first opportunity to go heavy to the downside for the first time that I've been here. So it's been a while. Anyway, hope you guys have a great trading day. I will catch up with you in a little bit. If I don't see you, I will see you tomorrow at 8:45 here for Friday's session and the 1st of August at Market Masters. Have a great day.